Morning, ladies and gentlemen. Marty Switzer here for the Contango Income Generator Investor Call, December 2019. I'm the CEO of Contango Asset Management. I'll be facilitating the presentation today. Fantastic to have a number of our shareholders on the line. This session is really all about you. It's a chance to you to hear from our portfolio manager, Shawn, I'll introduce in a minute. Shawn will give you an update on his view on the world, how the portfolio is performing. This is your chance to ask questions. We're happy to talk about all things markets, all things portfolio, strategy that we're deploying successfully so far with regards to closing the share price discount to NTA, which we're making good progress on. And it's really an open forum. I'll pick it off by asking Shawn a couple of questions. But if you have questions throughout the webinar, feel free to start writing in and we'll answer them, and we look forward to talking to you throughout the morning. So let's kick it off. Morning, Shawn.
Hi, Marty. How are you?
Very well, mate. Nice to be with you today. So look, in terms of opening the batting, Burnsy, obviously markets are at all-time highs. They've run hard since we did our last webinar on the back of Brexit. Good news coming out of the trade wars, phase one deal being sorted, the rotation, I guess, in the market. Can you give our shareholders a sort of house view from Contango and Switzer Asset Management on the macroeconomic backdrop right now, and what you think that means for stocks in 2020?
Okay, thanks, Marty. Yeah, I think that what we've seen, obviously a very strong year for stocks coming off a low base. Remember, the market sold off at the end of last year. So we're coming off a strong base, but also, moving towards highs, and that, for the Australian market, you have to remember that's with a big sector. The bank's not performing that well. So the rest of the market has really zoomed along. I think probably all this year that we've been, the basis thesis is that the central banks are prepared to put liquidity into the markets, into the economy, and they can do that while inflation stays low. That helps asset prices, and so and that's been basically the theme all year, and that will probably continue to run. But we're starting at a much higher base now than we were last year. What are the things to watch for the risks? We've got the trade war. Looks like that's calmed down, so that means a recession's been avoided. Growth is sort of ticking up a little bit, but there are other signs of excess in the market. There are pockets of excess. I was having a look yesterday. Greek bonds are at 1.3%, compared to the US at 1.9%. So, they were 12% a few years ago. Small health stocks, a lot of them certainly haven't got dividends. Some of them haven't got revenues, and they're up 2 or 3 times this year. So liquidity is piling into those areas. Not areas that are sort of CIE's domain. So, but that's probably the first places that'll come off of this trouble. We're looking at inflation. We're looking at credit spreads to see how the market is the health of the market. And at the moment, there looks like there's no real issues. So we can see they're the things that we're sort of concentrating on going forward.
So Burnsy, rates lower for longer, and I guess positive growth for stocks in 2020.
Yeah, I think we've seen the bond market sort of rallied, so that's lower interest rates. When the trade war looks like it could escalate and bring on a recession, we saw the Australian long bond below 1%. The US, I think, got down to about 1.4. They've sort of normalised back up, so got about 1.9 on the US and 1.2, 1.3 on the Aussie. Interesting to see where they actually settle. It's very important to see that the bond market sort of take the increase in growth and settle around these levels or a little bit higher. That will give the market confidence to keep going on. But 1.9, 1.2, 1.3 in Australia is certainly, they're still very low interest rates.
Shawn, the portfolio, can you run us through how it's performed over the quarter and how it's performed over 2019 and any sort of other interesting details you think a shareholder should know about how you're managing it?
Yeah, I think that this year we've moved up with the market. Ordinarily in strong markets, CIE will lag, and that's been the case this year. So we're up about over 19%, which is a good return. Not as much as the market. The flip side of that is that when what we'd like to see is when markets fall, go the other way, decline, that we actually do better than the market. So the September quarter, we're up to about 1%. Again, less than the market. Those days that the interesting days that I think for CIE is when the market gets clobbered. I like to have a look to see how we go, and whether we do better than the market when the market declines, and that's been the case. So that sort of gives us hopefully a bit of confidence that we will track the market higher. We're not in those areas that are probably more racy. We are quite conservative, but we also like to try and keep our capital if things suddenly turn for the worse. So we're progressing along at a conservative rate. That's probably what I'd say.
Yeah. Burns, I want to talk about the changes that we made, which we spoke about at the last investor call around the investment framework. But also too, I'd like to invite the audience, if you have questions, start entering them into the, Tom, where do we enter them? We enter them into the control panel, that you'll see on your screen, the go-to webinar control panel. Enter them in there and we'll start taking them and get the conversation as interactive as possible. Burnsy, the investment framework, there were some refinements made to it to provide more flexibility to look for stocks that can provide a bit more growth to help with the income side of things.
Yeah.
Can you sort of run us through how that's played out, and then talk us through some of the companies that you're looking at now that maybe historically you've sort of stayed away from?
Yeah, sure. I suppose that, we just as a bit of a backdrop, I think CIE has been very much an X20, originally X30 yield portfolio, and kept pretty much 100% in that space. And what we've noticed in that, when you swim in that pool, that there isn't much growth. So the sort of type of stocks that Aristocrat is probably one of the first ones we put in there, and that's been successful. Another one is we saw opportunity in Lendlease that we bought it around $12. Now it's we just sold some actually around $19 a couple of days ago. So that's been good. We've also dabbled in the resource space and bought some Aluka and Fortescue. We have a framework in terms of when we are interested in those stocks. They've obviously both quite high from where we've bought them. Another one is Origin. That's a company that we've looked at for quite some time. Going back several years, they were almost insolvent. They've fixed themselves up. Balance sheet is back down to reasonable shape. They're paying a dividend. Franking starting to come through. Also, they have a exposure to oil, which I think is interesting. And certainly at these oil prices, they're starting to make a lot of money. So we entered Origin, and that's up as well. Actually, our strike rate amongst these new type of stocks is actually quite high at the moment, so it encourages us to keep going. I mean, what other interesting stocks, just to give you an idea what we're looking at, and we met management on all of these companies, and we are actually monitoring them just to give you a feel of where we're looking for opportunities. Stocks like Breville, Webjet, Bravura, and Hub24 is sort of like the stocks where we're sort of think they're interesting. We also we like to pick them off when we think they're opportunistic to get involved in them. So there will be a portion of the portfolio that is allocated to drive capital growth. So that's the plan.
This is the Contango Income Generator Investor Call. I'm Marty Switzer. With me is Portfolio Manager Shawn Burns. We are taking questions from our audience, and we've just received our first question from our good friend Satish. Satish, thank you for your question. You said after the last call, you've seen that the share price has gone up to the mid 80-cent range, but it's still below the dollar price that you paid at the IPO. It's obviously an LIC that's been around for a number of years, and a number of shareholders bought in at different entry prices, but you did buy it in the IPO and you've been a very loyal supporter, which is fantastic, and you've been provided income. The question also continues, are there any plans to continue to get the share price up, and is there any strategy to keep it below the IPO price? No, absolutely no strategy to keep it below. Look, I think CIE traditionally has traded at a discount of about sort of 5%, which is at the lower end of the range for listed investment companies, and a big part of that is because of all the income that it does pay out. Look, our strategy, Satish, is absolutely to get this thing trading at NTA or better. Me as CEO of the company, the only way I can grow a listed investment company is if it trades at NTA or above, so we're highly incentivized to get it trading above there. You're right, we've made good progress in terms of closing the discount. I think for a new investor, the share price is up 15-16% since June, July, when we refined our marketing strategy to focus on the direct market, where we were sort of going down more of an advisor path. We're seeing good progress there. We're sort of trading around 86 cents. We've been as high as 89. We want to get this thing well above the current NTA, which is about 96, 97. The higher the better, and we're working really hard on the marketing front to ensure that happens. What do we need to do? Well, we've got to continue to pay the yield. It's an income play. We've got to perform well, and we've got to market well. And we're doing things like these webinars today. We're still targeting the advisor market, targeting advisors that do want to promote it, albeit the focus is direct. We've been doing a lot of conferences and strategy days. Shawn's doing a lot of investor communication. So we're working really hard to get that share price up, and we're really encouraged with the progress that we've made over the last few months, but we certainly won't be stopping here. So thank you for your question. Next question from Jeff Smith. Are there any slides for this presentation? Tom's just writing back to Jeff, but look, it is an audio presentation, Jeff, so we haven't done any slides. It's sort of more, I guess, radio sort of style Q&A, investor calls. We will take that on notice, though, and think about whether or not we should do one for next time. So thank you for that question. We're open now. We're taking questions. Feel free to key one into the control panel on the right there, the GoToWebinar control panel. Bernsey, one of the things that I guess is a narrative that's being discussed in the market now for some time, I guess, is this rotation from sort of growth stocks to value stocks, which is an interesting one that normally value stocks sort of seem to do better when the economy is a bit stronger and rates are rising, but we're in this sort of low rate environment. We're talking about sort of shifting to value. Can you sort of just dissect this whole sort of theme and what you think it sort of means, why are we talking about it, and what does it mean for our portfolio?
Yeah, sure. I think it's, I won't get into too much financial theory here, but value stocks are usually low PE stocks that pay a big yield. Usually that's where a lot of CIE sits, and they're low PE because usually they're lower growth. And what we've probably found since 2012, when the world went into a low growth and low interest rate era, is that these stocks, these companies actually need a lot of activity to generate excess returns. So they've actually been an area that is struggled over against growth, where growth companies are more like.
A long time now, isn't it?
Yeah, for years. And growth companies are companies that usually grow irrespective of what the economy does. Like they may have a product that has secular growth. We want, so health is a good area that where people are using more and more products. And that is the area that the market is priced in. Interest rates are very important in when you look at this and how the focus moves from one area to the other. Probably this year's been a bit unusual. Interest rates went very low when markets was a bit apprehensive about the trade war and whether that would bring on a recession. So we had, and that pushed up growth stocks, etc. Though that, as I said, the trade war looks like it has subsided, the risk of the trade war. Interest rates have moved up, as the US from about 1.4 to 1.9. That has helped. So I think the way to look at it is that sort of like brought value stocks back from a pretty poor outlook of a recession. Whether it's enough to make them kick on and keep going, I'd be, that is probably a bit of a question mark, I'd say. So I think that we've probably got more to run in terms of lower interest rates, lower inflation, lower growth. So a bit of a retracement, a bit of relief for value stocks, but I suspect that I can't see them. I don't think it's a change of a cycle yet. I think we've probably got 18 months to go on that. So we're a bit of a blend where we are. We have. We are adding a few growth stocks. We haven't got that many. We're looking to add a few more. It's probably a good time if they get sold off in this period now to have a look at that. We do hold a fair bit in REITs, utilities and infrastructure. They're also interest rate sensitive. They're sort of like a block of the portfolio that are very stable and produce income. And then we have a big value component that gives a lot of the franking for the portfolio.
We've got a question from Ian Henderson. Ian, thanks for your question. Are you following any stocks that are disruptors in nature, is the question. Thank you, Ian. Shawn?
Yeah, that's, well, I mean, the disruptors are usually newer companies. A lot of them are obviously high growth companies because they're eating into established companies like banks or telcos, etc., that are finding a new product or new process to grow their top line. Usually they aren't dividend payers. A lot of them are like also formulative in stage. Some of them haven't got profits yet, and some are don't pay dividends, haven't got profits, and etc. And highly priced. So that's so they're not a natural domain for CIE. As I said before, we are looking at something like Hub24. That's a disruptor in the platform space. It's taking share. So I think that where we sit is probably it's not a natural fit for us, but we do see opportunities where we see opportunities, and they have to probably be more developed than just an idea or an early stage company. They have to be sort of have a proven model that is winning share. And also, things don't go smoothly for them. They do have their ups and downs. What we'd like to do is if they run in a bit of temporary problems, that we've done the work and can add them in, and they'd be part of our growth segment of the portfolio, which we will allocate. We're allocating part of the fund to.
Bernsey, can you provide any sort of commentary on the WAAX stocks and maybe sort of tell the audience what we actually mean by WAAX? Yeah,
this is an area that it almost seems like every bull market has its focus of companies that do extraordinarily, that the market focuses on and drives the share price up. The WAAX is an anagram for the companies that have, they're mainly tech companies that have, so we're talking about WiseTech, Appen, Altium, Xero, and there's a couple of others sort of come in and out of that group. Now, the valuations of those, and Afterpay, did I mention? Afterpay Touch, yeah. So they're companies that are highly valued. They trade on multiples of revenue. Most of them don't pay dividends. They are disruptors. They're the top line growth. I think it's a case of those type of stocks that, and they've been enormously successful, in terms of share price. And how will we be talking about these in 5 years' time? I think there'll probably be winners and losers in that group. So it's a case of for investors in that to keep a close eye that their investment proposition that they're bringing to their clients is still relevant, and they can still take share and still grow their top line going forward. Again, outside of the orbit for CIE, we probably added those. I'd say that we're probably looking at the next level down where the businesses are a bit more developed. There's a bit more cash flow coming out, a chance of a dividend, but still growing that top line.
This is the Contango Income Generator investor call. We're with Shawn Burns, portfolio manager of Contango Income Generator. We'd love to hear from you, our shareholders, your time to ask questions. feel free. The control panel is there on the right, and you can type your question in there at any time. We've got another question coming in now, which is fantastic, from John Spalding. Brexit, president impeachment, and elections going forward in 2020. Your thoughts, Shawn? Thanks, John.
Yeah, I think, in some ways I see a lot of these issues, they really have to escalate dramatically to impact the market. Brexit had a good go, though the UK economy obviously not as big as it once was, but I think that now that looks like that's settled. So, we've got one stock that we've got a couple of stocks that have UK exposure, so they've been through a bit of a hard time. I think they're starting to improve. So something like Reliance Worldwide has made acquisition in the UK just before Brexit, so that wasn't great timing. But with once that settles down, we're starting to see the share price sort of pick up a bit. And also, we've got Iris, we've got Mill & Shakespeare, SG Fleet, all got sort of smallish to medium-sized UK businesses. And I think just getting rid of uncertainty, markets hate uncertainty, getting rid of it is a good thing for valuations. Impeachment, I suspect, just a personal view, I'd be surprised if that goes anywhere. But in terms of elections, that's actually the US election I suspect you're talking about there. That's actually quite important to see how that runs. I mean, some of the candidates have quite a wide range of policies there. Some of them are not market friendly, so we'll see how that runs, because that could be something that the markets could get concerned about if one of the candidates suddenly becomes a front runner and they've got market unfriendly policies. But I wouldn't say that's the case at this stage.
And in terms of the candidates that are there at the moment, I think there was some hope from some quarters that Mayor Bloomberg would be a chance, but I think the polling so far is suggesting that he's sort of nowhere really in the running.
No, not yet. No,
it's early days though.
It's early. Yeah, we've got basically a year to go.
Yeah.
You'd probably have to think it's going to be at this stage things can change very quickly in politics. But Trump versus Biden looks like the most likely outcome, with Trump winning. So more of the same. And then we'll see what that means for the ongoing duel with China.
We've got a question from Pradeep Gupta. Will you consider including stocks from ASX 30 to improve the CIE share price? Well, Shawn, I'll let you answer this, but this fund largely does invest in companies outside the top 30 to sort of 200. We can go within the top 20 as part of our new investment framework. So I think to Pradeep's question, I think we're doing that now to look at how we, continue to deliver on the income scenario. There's sort of two ways you can provide income through a listed investment company. It's through the actual dividends that you pay, but also through profits that you can generate. So we are looking for companies that have a bit more of a growth profile, Burnsy, to assist with that. But I might throw to you there.
Yeah, no, that's exactly right. We have opened that up. We don't want to become a top 10 fund where it's all full of top 10 companies, but we are opportunistic in going in and out of those top 20 companies. We do hold a few at the moment, and if we make money out of those, that's the aim. And also it helps the risk profile as well, because those companies are usually lower risk. If we see opportunities to make profits, then we will do that now.
But just to sort of follow on Pradeep's question, CIE has always traditionally invested in companies outside the 30, hasn't it, Shawn?
That's correct.
I think even now we're well over 70%.
Yes, that's
companies between 30 and 200, yeah.
Yeah. It's 80, 85, yeah. So it's. I mean, that's its home. I think that what we're just looking at the risk. I mean, the thing that scares me the most is like trying to, or the thing we focus on, and the thing we like to avoid is like companies that have earnings downgrades, and that's, if we can sell, if we think one of our stocks looks like it's going to have earnings downgrade, we can sell it. We can buy a lower risk stock and reduce the risk of the portfolio. So that's the strategy there.
Another one from Pradeep. Will you invest in overseas companies? Well, look, the answer to that is no. It's obviously we're investing in Australian companies, but Shawn, I guess part of the portfolio would have a fair bit of revenues from overseas, wouldn't it? So you do get exposure globally from that perspective, yeah?
Yeah, I think that, that's correct. And I think that's probably something that's going to happen with the portfolio as we look to more. Most of the growth stories have overseas operations. They also have, that means less franking. That's probably a reason why we haven't been as active in that area, because you don't get franking from profits overseas. But that's where a lot of the growth is, especially some of these mid-sized companies. They get a product that they can sell overseas, gets traction. And then you get your exposure to growth companies and overseas companies as well.
I've got a question from Mr. Balachandran. Are we planning to invest in companies that are producing medical cannabis, Shawn?
So,
not yet.
Not yet. No, I think they probably just need to. I mean, I'd say I'd just probably make a wider comment on how I see CIA acting in investors' portfolios. This is a income focused fund. It's also investing in companies which we try to be stable, we try to be conservative, we try to give you income, and we try and get a bit of capital growth as well. So it plays that part in a blended portfolio. Outside of that, it's a case of if people love a story, then and it's higher growth, higher risk, you can blend it into your portfolio. Ask your advisor about that. So, but CIE is inherently it is conservative, and we like to make sure we can keep paying a dividend for people who want the income.
Yeah. Another question, sort of, I guess, on the topic of yield from John. Can the big banks maintain their yield long term, Shawn? I think obviously big exposure to the banks in the Switzer Dividend Growth Fund, the sister fund of CIE, but we do have some exposure just for some income in terms of the banks in CIE these days. You're pretty experienced in talking banks over here.
I'm a bit cautious on the bank's dividend profile. You've seen now 3 have been cut, so ANZ, NAB, Westpac all cut their dividends. CBA still holding on, and all I'd say is that I think that things are still tough for the big banks. They do have very, very high. In fact, I wrote a note to one of the board members, this week. So we've got and I'm just reading from it now, gross yield for NAB and Westpac of 10 and 9.3%, 9.3 for NAB, 10 for Westpac gross yield. Those are incredibly high. I mean, if you were sure they'd be there forever, you'd be putting everything you had in them. And I think they're not there forever. I think we're going to see. I suspect that we are, in our thinking, we are cutting in, and we are putting in that there will be cuts in the dividends. What we like to do is have a look and say, what will those cuts be? How will they be? What does a year look like post that? Does that still make sense? So we are seeing and one of the, I think NAB and Westpac both had in their presentations, they've been forced to hold a lot more capital. All that capital they're earning is in interest rate products. Interest rates are falling. So they've hedged, they've done what you expect them to do. They've hedged that out to try and lock in high interest rates, but those interest rates are running out. So that's a headwind, going over the next couple of years for them, as low interest rates are no good for banks, and that will be a challenge for them. It wouldn't surprise me if there's still they've done one cut. There's probably a smaller one to come in the future. That would be my that's my thinking at the moment. If those interest rates stay where they are, higher interest rates will obviously help the banks.
Shawn, any stocks that you'd like to sort of talk about before we sort of wrap up the session? Unless we have more questions, and we're happy to stay here and answer questions throughout the morning. But
I think that some of Yeah, it's funny. We invest in these stocks, and some, as I said, as I've been saying over the last few years, that it wouldn't surprise me if some of our stocks attract takeover attention. And one of our top 10 stocks has been bid for. That's Caltex. It had, it has been struggling a bit over the last year or so with discounting in the may not seem like it, but there is discounting in the petrol station space at the moment. And that is opened the opportunity for a big Canadian firm to come and bid for them. I think their bid is a little bit light on at the moment, around $34. When I first heard it, I was hoping somewhere closer to 40. This is a big holding. It's their second biggest holding at the moment. We'd like to see, that probably goes quite a bit over Christmas now, but we'd like to see the Canadians come back with a higher bid for Caltex, which would be helpful for us. And I think those assets there are excellent assets. I think, Aristocrat, we still, we've been toying with that one a bit, but that's done better than expected. I'm also positive on Origin continuing to improve its balance sheet, and these oil prices help it grow. And I think some of the more defensive stocks, like we added a bit more into Atlas Arteria, which has toll roads in France and the US, but mainly the toll roads out of Paris. They changed their structure a bit. They bought Macquarie Bank out, they bought some more of those, more of those French toll roads. We think that's a good deal, so we're positive on them. And also Aviva REIT, which owns is landlord to the Shell service stations. We like that story as well, which is quite defensive and guaranteed growth, which is good. So that's a couple of stories we're keen on.
Yeah. Another question from one of our shareholders, Mr. Henderson. Do you see any opportunities in the smaller banks? Well, Shawn, again, you know a lot about the smaller banks, and you've owned the portfolio for a number of years. Can you talk us through that?
Yeah, I think we own three smaller banks in the fund, and together they're about 8% of the portfolio, and that's MyState, Bank of Queensland, and Bendigo Bank. In the last, we've actually had them all through our office. We had the CFO of Bendigo and the CEO of MyState in the last week or so. I think banking is a tough game. Why the regionals are interesting, I think, is that the big, when you look at as I haven't done the work, but I saw it done by someone, that the losses out of remediation from the Royal Commission are now bigger than the losses suffered by the big banks during the GFC. So we're talking big numbers here. They're disrupted. I think that what makes us a little bit positive on the regional banks, who are still in, there's still a tough game banking, is that while those big banks are disrupted, that they can increase their share, and as long as they have their IT in place to do that. And I think, two of the MyState and Bendigo are in that position now. I mean, we had, as I said, we had two of the senior officers in over the last week or so, and I think they said it's tough, but we're comfortable and confident in the position we're in to take the game up to these guys, which is what you want. I think Bank of Queensland, I mean, that is that probably hasn't, it's disappointing they haven't been in the position to take advantage of the big banks. They've had a capital raising, which I don't think, and Westpac's had a capital raising as well. I don't think certainly the professional market is not that keen on bank equities at the moment. So I think that's very, very, that's made the markets quite sloppy and weak. Interesting to see the Bank of Queensland chairman and CEO are buying significant amounts of stock in the market at the moment. So they think it's cheap. And I think that's probably right. I think it's cheap at the moment, though. I have to, we did sell some Bank of Queensland earlier in the month. We are watching their progress very closely. It's probably a bit too cheap at the moment, though they have a lot of work to do. The other two, I think we're quite comfortable with.
Thanks, Shawn. I guess this is the last chance for any questions before I make a few closing remarks. There still is time, and we would love to hear from you if there's anything that hasn't been asked. In terms of sort of wrapping up, we've made some changes to the investment framework, to the dividend policy, which we believe have been well received. We believe it was the right thing to do. We were delighted to be able to pay a fully franked dividend or announced that we will be paying a fully franked dividend in our last dividend announcement, and that is, I guess, one of the focuses that we mentioned was that we would be increasing the levels of franking on CIE, and Shawn's working really hard to deliver on that sort of promise that we're making. We think this investment company creates a fantastic opportunity for investors to add to their holding. The discounts closed by sort of around 10% over the last couple of months. The share price is up around 15%. The historical average of this LIC, the discount, is around 5%. So we think there's definitely 5% there to make at a minimum, plus you get the income. But most importantly, we're really focused on getting it back to NTA or above, so we can look to increase the size of the LIC at the right time. So we're very focused on that NTA number. It's a massive priority for me as CEO and for our distribution team and for the work that Shawn and his investment team are doing. So if you do think that you're underweight sort of mid-cap income, we think this is a great time to add to your holding. Most importantly, we'd like to thank all our shareholders for the trust and faith and support that you placed in us over the year, and for many of you for a number of years. We're very grateful. We don't take responsibility lightly, and we really do appreciate you trusting us to assist you in managing your financial affairs. If there are no more questions, I'd like to sort of wrap it up there, and thank Shawn and the investment team and Tom, who's in the room now, for all the great work he's been doing to promote the CIA brand. And I'd like to thank once again all our shareholders and wish everyone a wonderful, merry, safe, prosperous, happy Christmas and New Year period. So with that, we might take the chance to say goodbye. Shawn, thank you very much, and look forward to seeing you again on one of these webinars early in the new year. Anything else we need to say, Tom?
That's it. We'll do these things quarterly moving forward. So the next one should be in March, and they are recorded as well. So you'll be able to see this on the website this afternoon.
Thank you all, and Merry Christmas, Happy New Year, Happy Holidays. Best of luck.
Bye all.